There's a number that stopped me cold when I was prepping for today's show. Citizens Financial Group just posted earnings per share of $1.13 for the first quarter of 2026. That's a 47% jump from the same quarter a year ago.
And what makes that number even more interesting is where it came from. This wasn't a one-time item or a tax benefit. Net interest income grew 12% year over year, the net interest margin hit 3.14%, and credit quality improved sharply. This is an operational improvement story.
That's exactly what we're going to unpack today. I'm Hudson Thomas, and you're listening to Charged Alpha, the show where we break down one company at a time, one quarter at a time. Today's episode is all about Citizens Financial Group, ticker CFG, coming off a very strong first quarter of 2026.
I'm Lana Chen, and today we're going to talk about structural NIM expansion, a private banking business that nearly doubled in 1 year, sharply improving credit quality, and what all of that means for where this bank is headed. Let's get into it.
So let's set the stage with who Citizens Financial Group actually is. This is one of America's oldest banking institutions, founded in 1828, originally as High Street Bank in Providence, Rhode Island. Nearly 200 years later, it's still headquartered in that same city.
By the numbers, Citizens is one of the largest regional banks in the United States. We're talking about $228 billion in total assets, operations across 14 states, and over 1,000 branch locations. It employs roughly 17,000 people.
The way they make money is classic banking. They take in deposits and lend those deposits out at a higher rate. Net interest income, the spread between what they earn on loans and what they pay on deposits, makes up roughly 72% of total revenue. The rest comes from fees, mortgage banking, capital markets advisory, and wealth management.
Here's the backstory on how Citizens got to where it is. The bank was actually owned by Royal Bank of Scotland, RBS, for decades. When RBS ran into trouble after the financial crisis and needed to raise capital, Citizens was the asset they sold. RBS took Citizens public in September 2014 in what was one of the largest bank IPOs in U.S. history.
And the new Citizens didn't look like a typical freshly spun-off bank. They had a clear transformation agenda from day one: diversify revenue, build out wealth management, enter private banking. A decade later, that agenda is starting to bear serious fruit.
The private banking initiative is the most interesting piece. Citizens has been building out a private banking unit targeting wealthy clients, think mass affluent to high net worth, and it's growing fast. Assets under management in that segment nearly doubled year over year, reaching $10.1 billion by the end of the first quarter.
From a competitive moat standpoint, Citizens has a sticky deposit franchise built over 2 centuries of operations across 14 states. Those are long-term commercial and retail relationships that don't walk out the door easily. And the private banking build is creating a fee-generating engine that's relatively insulated from interest rate swings.
For industry context, regional banks are having a moment right now. The big concern coming into 2026 was whether credit quality would hold up after the rate cycle. For Citizens, the answer has been yes, and then some.
Now let's talk about the person at the top. Citizens Financial Group is led by Bruce Van Saun, who has been CEO since 2013. He came to Citizens as CFO of Royal Bank of Scotland, and then stayed as the new company's CEO through the IPO and the decade of transformation that followed.
Van Saun's reputation in banking is as a disciplined capital allocator and a transformation architect. He oversaw the divestiture of non-core assets, the build-out of the private bank, and the strategic shift toward higher-returning revenue streams. He's been consistent about setting multi-year financial targets, 15 to 16% return on tangible common equity by 2027. And the first quarter results suggest the bank is tracking toward those targets.
That kind of long-term operational discipline is what you want to see from a bank CEO. It's not flashy, but banking rarely rewards flashy.
Let's dig into the financials. I want to start with the headline numbers from the first quarter of 2026 because they tell a clear story. Revenue came in at $2.17 billion versus a $2.16 billion estimate, a narrow beat. But the earnings per share beat was more meaningful. $1.13 versus a $1.10 estimate.
For context, that 47% year-over-year EPS growth isn't because of some accounting trick or buyback math. Net income itself, actual dollars flowing to the bottom line, grew 39% year-over-year to $517 million.
Now, for a bank, the single most important metric, net interest margin. Citizens reported a NIM of 3.14% in the first quarter, up 24 basis points from a year ago and up 7 basis points from the prior quarter. That is a meaningful, consistent move higher.
And here's what makes the NIM story compelling. Part of the expansion isn't dependent on the Federal Reserve at all. Citizens has a portfolio of non-core loans that are running off and a book of interest rate swaps that have been terminated. Those two dynamics together are expected to contribute an additional 12 basis points of NIM improvement through the rest of 2026, regardless of what the Fed does.
That's a structural tailwind, not a cyclical one, and it matters a lot if you're worried about rate cuts. The Fed could cut twice this year, and Citizens still has built-in NIM expansion coming from the portfolio mechanics.
Let's talk about return on tangible common equity, which for banks is essentially the operating margin equivalent. Citizens reported ROTC of 12.2% in the first quarter. Management is targeting 15 to 16% by 2027. That gap, 12 to 15 or 16, is where the earnings growth story lives.
Credit quality is another standout this quarter. The net charge-off rate, that's the measure of loans going bad as a percentage of the portfolio, came in at 0.39%. A year ago, it was 0.58%, a drop of nearly 20 basis points. In bank terms, that's a significant credit quality improvement, and lower charge-offs means lower provisions, which means more revenue falls through to net income.
On the capital return front, Citizens returned $498 million to shareholders in just the first quarter, $300 million in share repurchases, and $198 million in dividends. That's a serious capital return program for a bank with a market cap under $30 billion.
The balance sheet is in solid shape. CET1, the key regulatory capital ratio, came in at 10.5%, comfortably above regulatory minimums. Total assets stand at $228 billion, and the bank's price-to-tangible book ratio is roughly 1.56 times.
On headline valuation, Citizens trades at about 15.3 times trailing earnings and 13.6 times forward estimates. The price-to-book ratio is just over 1 times, which is modest pricing for a bank showing this kind of earnings trajectory.
The dividend yield is 2.73%. That's real income while you wait for the ROTC expansion thesis to play out. Forward estimates call for earnings per share of around $4.74 for full year 2026, implying meaningful acceleration from 2025's base of $3.86.
Loan growth is the one soft spot worth flagging. Period-end loans grew just 1.6% year over year. This isn't a volume-driven story. It's a margin-driven story. NIM is doing the heavy lifting on revenue growth.
Overall, Citizens Financial's financial health is strong. The capital ratios are solid, credit quality is improving rapidly, the NIM is expanding structurally, and the bank is generating significant cash flow to return to shareholders. The one watch item is whether loan growth reaccelerates as commercial borrowing demand picks up.
Let's talk about what Wall Street is saying. What does the analyst community make of Citizens right now?
The analyst consensus on Citizens is a moderate buy. 13 analysts cover the stock, and the breakdown is 4 buys, 8 holds, and 1 sell. The average price target sits around $72, against a current price of $64.45, implying about 11.7% upside.
After the first quarter beat, a few analysts got notably more constructive. Evercore ISI raised their price target from $69 to $77 and reiterated an outperform rating that's the highest target on the street right now. Goldman Sachs maintained a $73 target and kept Citizens on their conviction buy list.
RBC Capital Markets also raised their target from $67 to $70 and reiterated an outperform. Cantor Fitzgerald has a $75 target with an overweight rating. The average of those notable calls is around $73 to $74. roughly 14% above where the stock trades.
The bears on the street are largely in the hold camp, rather than the sell camp. The concern from the holds is mostly about rate sensitivity. What happens if the Fed cuts rates faster than expected and compresses the rate-dependent portion of NIM?
The Q1 earnings report was well received overall. EPS of 113 versus a 110 estimate. Revenue of $2.17 billion versus a $2.16 billion estimate. Management guided for continued NIM expansion and stable credit quality into the second quarter, which is exactly what investors wanted to hear.
Let's get into the bull and bear case. I'll lead with the bull side because there's a lot to work with.
Make the case.
Bull argument 1, structural NIM expansion. Management has essentially told investors that 12 basis points of NIM improvement are coming through year-end regardless of the Federal Reserve. That's from the non-core loan runoff and terminated swap portfolio. You don't need a macro tailwind. The improvement is already in the engine. Bull argument 2, the private banking build. Citizens' private banking division went from $5.2 billion in AUM to $10.1 billion in 1 year. That's a 94% increase. The segment is generating returns on equity above 25%. This is a secular revenue diversifier that makes the bank less rate sensitive over time, and it's only at the beginning of its growth trajectory. And bull argument 3, the convergence of credit improvement and capital return capacity. NCO rates are falling, provisions are declining, and CET1 at 10.5 gives management plenty of room to keep buying back stock. $498 million in just 1 quarter. That's a serious capital return program.
All right, here's the bear case. Rate sensitivity is the big one. Citizens is not fully insulated from Fed rate cuts. Roughly 60% of the loan book is floating rate. If the Fed cuts by a full percentage point over the next 12 months, that's a real headwind to net interest income that the structural tailwinds only partially offset. Second bear argument, loan growth. 1.6% year over year is not inspiring. If commercial borrowing demand doesn't recover, Citizens is almost entirely dependent on margin expansion for revenue growth. That's a thinner margin for error than investors might want. And third, commercial real estate. Citizens has exposure to office and retail CRE at a time when valuations in those segments are still under pressure. A deterioration in that portfolio could reverse the credit quality progress we just saw.
Both sides have real merit. I think the structural NIM story is genuinely differentiated. Not every bank has that 12 basis point tailwind locked in. But the rate sensitivity risk is real, and loan growth will need to come back eventually for this to be a complete story.
The thesis really comes down to whether management's pathway to 15 to 16% ROTCE by 2027 is credible. Quarter 1 suggests it is.
Let me pull in some peer context. In regional banking, the right valuation lens isn't price to sales, it's price to tangible book value. Citizens trades at about 1.56 times tangible book right now. How does that stack up against peers?
Regions Financial, RF, trades at roughly 1.5 times tangible book. They have a higher ROTCE of around 17%, so they arguably deserve a slight premium to Citizens today. Huntington Bancshares comes in at about 1.4 times tangible book with a comparable NIM profile, but already running near 15% ROTCE, less room for upside from multiple expansion. KeyCorp sits below 1 times tangible book, reflecting its lower ROTCE of around 9%.
So CFG at 1.56 sits toward the higher end of the peer group. But importantly, it's trading at a discount to where it should be if ROTCE reaches 15 to 16%. If management delivers on the 2027 guidance, you'd expect meaningful multiple expansion.
The private banking differentiation is the piece that's hardest to price comparatively. Most regional banks don't have a high ROE wealth management business embedded in them growing this fast. Citizens does. That's a real differentiated asset.
Let's check in on the options market. Put-call ratios on CFG have been running around 0.72, which suggests the options market is leaning slightly bullish. Implied volatility is around the 45th percentile, not elevated, which is typical post-earnings as the near-term uncertainty resolves.
What's notable in the options flow is call buying at the $70 strike in June and September expirations. That aligns with the analyst price target cluster of $70 to $77. Options participants appear to be positioning for the 12% upside scenario over a 3 to 6 month horizon, rather than expecting a dramatic move in either direction.
Standard caveat applies. Options activity reflects positioning and hedging, not crystal balls. But the fact that the put-call ratio is below 1 and the notable activity is in out-of-the-money calls suggests market participants aren't bearish on this one post-earnings.
On the insider front, there hasn't been significant open market buying or selling from officers or directors recently. One director sold shares through a pre-scheduled 10b5-1 plan, which is standard pre-planned selling rather than a directional bet.
The more meaningful insider signal is what the company itself is doing. $300 million in buybacks in the first quarter at $64 per share. When management authorizes and executes that level of repurchase, they're putting capital to work based on their own internal earnings outlook. That's the most credible form of insider confidence we see in banking.
The primary risk going forward is rate sensitivity. If the Fed cuts faster or deeper than expected, the non-structural portion of Citizens' NIM will come under pressure. Watch the quarterly NIM figure carefully. If it stalls at 3.14 or dips, that changes the ROTC trajectory.
The secondary risk is commercial real estate. Citizens hasn't reported significant deterioration, but the sector-wide stress in office and retail CRE hasn't fully resolved. Any credit event there would show up in the charge-off rate, the other key number to watch alongside NIM.
And third, the private bank ramp-up costs. Citizens is still investing in hiring private bankers and building out the wealth platform. If AUM growth decelerates, the cost base could outpace the revenue benefit. That would show up in the efficiency ratio, trending higher rather than lower.
The positive catalyst to watch is the continued NIM expansion into the second quarter. Management guided for 5 to 7 more basis points of expansion. If Citizens reports a NIM above 3.20% in July, the story gets materially more compelling, and price targets will follow. Let's bring it all together. Citizens Financial Group had a genuinely strong first quarter of 2026, 47% EPS growth, an expanding NIM, improving credit quality, and a massive capital return program. The bank is executing well on a credible earnings power improvement story.
The question for investors isn't whether the quarter was good. It clearly was. The question is whether the trajectory is sustainable. If the structural NIM tailwinds deliver as guided and the private bank continues its growth, and credit quality holds, Citizens has a clear path from 12% ROTE today to 15% or more by 2027.
The key metric to watch is the net interest margin in the second quarter. If NIM expands to 3.20% or above, that's evidence the structural tailwinds are on track. If it stalls or compresses, the thesis needs reassessment.
At $64, with a 2.7% dividend and 11+% upside to consensus targets, Citizens is a bank that's paying you to wait for its earnings power to show up in the stock price.
Today's closing quote comes from Warren Buffett, and it lands perfectly for this episode. He once said, "Banking is a very good business unless you do dumb things." Citizens Financial is a reminder that steady, disciplined execution is how banking companies actually create value over time.
47% EPS growth and 39% net income growth in a single quarter suggests they are, in fact, doing the right things.
That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.